Hey guys, welcome back to another episode. Today we're going to take a quick look at Zoom. The company is down about 16% after reported earnings. And may I say, I don't think earnings were that bad. So in today's episode, we're going to take a quick look at what happened. I'm going to share my overall thoughts. But before we do that, guys, make sure to hit the thumbs up. Make sure to hit the subscribe button. And check out the pinned comment where I have 10 free stock ideas. And I also have this awesome presentation where I take a quick look at all the stocks and all the information that I've been covering 100% free for you guys. So make sure to check that out. So like I said, Zoom right now is down about 16%. Earlier on, it was down a little bit more, over 18%. It broke below that $200 price point after reporting earnings. But we can see this is a company that has taken a huge beat. In the past, from its 52-week high, the stock is down about 57.5%. So let's just jump right into earnings, right? Company reported Q3 revenue of $1.05 billion. That was up about 35% year over year and about 3% quarter over quarter. They did see a nice increase in Zoom phones with triple-digit revenue growth. Customers with over 10 or more employees reached 512,000, and that was up 18% year over year and was also up 1.4% quarter over quarter. If we take a look at customers with over $100,000 of trailing 12 months revenue, rose to 2,507. That was up 94% year over year and 10% quarter over quarter. And we can take a quick look at these graphs, right? The company shows strong growth in revenue growth, up strong digits, and same with those expanding customer base like I was just talking about. The company did give guidance for Q4, and Q4 revenue was about $1.05 billion. That represents about a 19% year over year growth and is pretty much flat quarter over quarter, right? We can see it's pretty much the same amount of revenue made this quarter. And I do believe this is probably one of the main reasons the stock price has taken a quick hit. First, last year, Zoom was growing at that triple-digit growth rate. This year, it's growing at that high double-digit 35%, like we saw this quarter, right? Was it 35%? And now they're expecting next quarter to be about 19% year-over-year growth. The problem is now Zoom is not growing at how it was. But I believe now with the stock price, we're going to see in a bit, the price to sales ratio is matching the type of growth this company is seeing. Do you want 10 free stock picks right now? Well, if you do, let's take a quick listen to today's sponsor, a great reason why I'm able to provide so much content to you guys for free. I want to thank the Motley Fool for sponsoring this video. Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Stock Advisor has beat the market by more than 4x. Go to fool.com/Jose to get your free 10 stock picks now. I also want to mention some highlights, right? This company is growing internationally. Rest of the world is up 47% year over year. And the Americas revenue is up 30% year over year. And let's take a quick look at that chart. We can see here the overall year over year growth for rest of the world and Americas. The second thing we're seeing is revenue share per regions. It used to be, and it still is, America dependent, in my opinion. America's dependent. Most of the revenue right now comes from it, 66.6% this quarter, compared to the same time being 69.3%. So there is a decrease in dependency, still huge dependent in the America market, but we are seeing an increase in Europe, Middle East, and Africa, and the APAC. I want to say Europe, Middle East, and Africa is probably seeing the most growth percentage point wise, which is great to see. We also see that Zoom has a healthy cash and cash flow from operations right now, with about $5.4 billion in cash available to them, and free cash flow from operations this quarter about $375 million. That's over 33% free cash flow margins this quarter. Strong cash flow machine. Strong cash position. This is a company that, in my opinion, even though free cash flow is high right now, it really depends on when they get their money from those kind of contracts. Some quarters may have high fluctuation. Quarters may have high fluctuation in free cash flow margins. I think for a company like Zoom, it's probably better to look at trailing 12-month free cash flow margins, which are pretty high. I want to say closer to that 50% level. What else do we have? So some things to know. One of the main reasons stock price is down, numerous analysts have decreased the price target for Zoom. If we take a quick look here, I have numerous analysts dropping to 235 from 255, dropping to 344 from 398, to 245 from 275, to 250 from 304, and the list goes on. I have numerous analysts that in the past day after reporting earnings, and just today on November 23rd, have decreased their price target. On average, most maintain their normal rating and are just decreasing price target. I do believe this bearish sentiment plus the overall bearish sentiment happening in the stock market right now is really driving this stock price down, because earnings, in my opinion, were not that bad. Especially if we take a look now at forward price to sales ratio for Zoom, it's looking at price to sales ratio of 12.6. In my opinion, and I could be completely wrong, for a software company, a SaaS with high margins, positive cash flow from operations, growing at double digits still, plenty of cash in its balance sheet, and is still increasing in markets, a 12.5 is getting it's getting pretty attractive, in my opinion. Maybe something below 10 is when real attractiveness comes in valuation wise, but 12.6, I don't think it's sitting half bad. Some other things that they mentioned, that they are increasing the percentage compared to revenue that they're using in research and development. For example, Q3, it represented about 6.4% of total revenue that research and developing, and this kind of doubled percentage point wise, and increased more monetarily wise. I think it was over 100% growth in actual monetary value, but they're using a lot of money right now to increase their overall technology and make sure they are in the first event in the advancement in here. They want to be one of the leaders. The reason why, they are seeing a lot of competition, right? We can see Microsoft and Facebook both came out with new kind of animated ways and kind of this metaverse talk of being able to communicate with your coworkers. So this increased competition from like Microsoft and Facebook has this company, in my opinion, doing more with research and development. Another thing that they did see is an increase in expenses in sales and marketing. The job market is pretty picky, especially if you are in tech right now. If you are in tech right now, in my opinion, you're able to leave really quickly and find a new job with higher pay. So the problem is not finding, it's not the current talent, it's finding that talent and making sure that talent stays. So for that, you need to have high pay. You need to make sure you have incentives for your employees to stay. If we take a quick look at technicals, let's just take a quick look at Zoom. I believe right now this price point around 205. Obviously, market is volatile. Stock prices can continue to go down, but this seems like a very healthy level in my opinion. If one wants to mid-dollar cost average, Zoom is in my portfolio right now. It would be something that might be one I might take a closer look at next week. I already dropped the 4 stocks I'm looking for this week, but maybe for next week, Zoom might be one I might be keeping an eye out for. So right now I have no intentions of buying, but in my opinion, earnings were not bad, and I can't understand why we see that 18% drop outside of the actual valuation, the actual market sentiment right now. But like I mentioned, that price to sales ratio at 12.6 right now, doesn't look half bad. So take care, guys. Have a good day and see you next time.